Hello and welcome to our full course lecture on governance. So this is an introduction to our governance. We're going to look in the future at corporate governance in detail. We'll look at the agency problem. We'll look at the details around corporate governance. But this is really an introduction to get us thinking about what governance is, why we need governance, so what the benefits of it are, some concepts around governance, and also how this relates to not-for-profit organisations as well as different stakeholders within organisations. So what are we talking about when we say governance? Well, what we're saying here is it's a system of business governance. So how we run that business. How we run that business should relate to shareholders. So we'll talk a little bit about what shareholders want, and overwhelmingly shareholders want increases in shareholder wealth. So they want the share price to increase and they want dividends to be paid. But also they want proper management of their assets. Remember, the shareholders are the owners of the business, so they want the assets within that business that they own to be managed correctly. We also need to think about other stakeholders. So we'll look in detail in this course at stakeholders, how we can categorise those stakeholders and how we can actually deal with those stakeholders. Stakeholders we'll define as being anyone who has a legitimate interest in the business. So they could be internal, like managers, employees, or they could be external, like suppliers, customers, the government. And we'll see how that business should relate to those different stakeholders. So our governance, our corporate governance that we're going to talk about, tells us how we should run our business properly so that it's run in the interest of the shareholders and the stakeholders. So why do we need this system of business governance? Why do we need rules around governing the business? Well, it's all to do with these joint stock companies that now exist. So joint stock companies are where there are shares issued in the company. That means that the business is owned by the shareholders, but that business is then run by management. So management are appointed by the shareholders to run that business. So management should be running that business in the interests of the shareholders, but that's not always the case. Remember, there's going to be a potential conflict, a conflict between the interests of the shareholders and the interests of management. And we'll look at that in detail in the next lecture when we look at the agency problem, because the managers are the agents of the shareholders who are the principals. So those agents, the management, run the business on behalf of the shareholders, and their interests aren't necessarily the same. So we need to think about putting rules in place to make sure that management run that business in the interests of the shareholders, the owners of the business. So some of the benefits that we have whenever there are governance rules in places. Well, what we could have is the business case for governance. Well, what a business is there in order to do is to provide long-term value. So that will mean that more wealth will be created. If we have better controls within that business, then that will lead to more wealth being created because there's less chance of fraud where money can be lost and less chance of error where again we can lose money. So we can make sure through having appropriate governance that better controls are in place and more wealth is created for the shareholders. Remember, maximising the wealth of shareholders is the number one aim of management. So by having this, we should have better management. So having governance in place will ensure that there's better management in order that the business runs more smoothly. That will increase the confidence that investors have in the business, that will encourage them to invest, and that in itself can increase the share price of the business and indeed therefore increase the wealth of the current shareholders. So all in all, this can attract investment. So having appropriate governance in place can mean that people are more willing to invest in the business. That's not just shareholders, but also other finance providers like the banks, for instance. If you have appropriate governance rules, if you run that business well, then the banks will be more likely to invest to provide finance because they trust that that business can actually have governance rules in place to make sure that that finance is used appropriately. So the purpose of having governance rules are, number one, to provide that monitoring function for monitoring management. So they'll make sure that the board is balanced. We'll look at the rules on the board in detail, and they'll make sure that there's an audit function in order to monitor the management of that business. All in all, this will provide long-term value for the shareholders. And remember, that's the thing that we're focusing on. So some of the concepts that we'll be coming across whenever we're talking about governance and corporate governance codes. Well, first of all, fairness. Governance seeks to ensure that there is fairness. That means that we have stakeholder equality. So we're going to look later on at all of the different stakeholders in the business and how that business should deal with those stakeholders. So by having fairness, we deal with those stakeholders in an equal way. We also have an ethical code, so that's not just the ACCA's ethical code, but a corporate code within the business so that we act in an ethical way when we're doing business. Also, that will mean that we have integrity, and again, that's part of the ethical code, both the ethical code provided by the ACCA and the ethical code provided by the business itself. When it comes to transparency, this is a really key concept. So transparency means that the business provides open information. It's sometimes thought of as having a default position of disclosure. So that rather than thinking, well, we should conceal this information, they should think, well, we should disclose everything. There's no overriding reason that we shouldn't disclose information. So transparency means that we provide open information, we give everything to the stakeholders in terms of the information requirements that they have, and we show that the business has a clear direction and scope. So transparency ensures that we are a trustworthy business. When it comes to independence, we'll see in the rules that there should be non-executive directors who don't work day to day within the business, but provide an independent view on the board. So that means that we get board independence. They're more likely to take an independent view of strategic decisions, for example. Honesty is another key concept of governance. That means honest reporting, i.e. reporting the facts, not reporting anything that's not true. And that means we have to take an ethical stance. And again, we'll look at ethics in detail later on in the course. We need to set responsibility, and the corporate governance codes that we will be looking at, make sure that responsibility is set within the organisation. Clear rules should be set, and there should be acceptance of that responsibility, so that if there are problems, well then we know how to deal with those problems and who should be dealing with them. Allied to that responsibility, we need to have accountability. So if there is a problem, we have clarity in who is accountable for that problem. And that feeds into risk management, which again we're going to look at in detail throughout this module. All of this means that there is what's called a reputation risk. By not having appropriate governance codes, we could have poor reputations for firms who maybe don't engage in ethical business. So we need to take a moral stance and make sure that we protect the reputation of the organisation. So let's look at some of this terminology in illustration 1. This will also give you an idea of the type of scenarios that come up in this module. So read through the scenario, get an idea of what's happening, maybe even have a go at the illustration, and then work through the answer with me. Remember, we're going to learn from these illustrations. It's not that I expect you to be able to do them straight away. We're going to read through the scenario, have a think about it, and then learn from the answer. The requirement for illustration 1 is to define transparency and construct the case for greater transparency in the governance of the Horrance Hoy Association. So we have here a charity, and we're going to discuss first of all transparency and then relate it to this organisation. So we need to start now to think about exam technique. What I need to focus on here is breaking up the requirement. So the first part of this will be to define transparency. Make sure you do that in isolation. Then construct the case for greater transparency. When you're writing the answer out in the exam, you need to put headings, and then you need to break your answer up into 3 or 4 lines of writing at any one time, so that the examiner can easily pick up from that exactly the point that you're trying to make, and of course give you a mark for each point that you're making. So we're defining transparency first of all. So define transparency. We talked about this in the lecture. Remember, transparency is usually defined in terms of openness and adopting a default position of information provision rather than concealment. So we're going to think about revealing all of our information rather than concealing it from, in this case, the people who are donating to the business. So that means unless there's an overwhelming reason not to disclose information of any kind, so maybe it would be commercial sensitivity that would mean you wouldn't, well, unless that is the case, then information should be disclosed or made available upon request to any interested stakeholder. And we'll look at what stakeholders are later on in the module. So the case for greater transparency at HHO. So this is a charity, it's an animal charity, and really we're thinking here that we're not providing enough information because people are getting the idea that the founder is living this lavish lifestyle. So transparency will have the effect of reassuring investors that their funds are being responsibly stewarded and that they're being used for worthwhile investments. In this case, in the charity, such as HHO, without shareholders in the conventional sense, donors may give money to support the charity's stated aims and purposes, and we need to make sure that we provide them with information. With the relief of suffering to animals being a prominent reason for any donor to give to HHO, the amount of money diverted for other purposes, such as salaries, administration, that sort of thing, will be information of considerable interest. So the donors will want to know about that. They'll want to know that their money is being used appropriately. So transparency would inform and placate HHO's critics, including the journalists who are investigating it, so provide them with the information as well. Public commentators like journalists are capable of causing damage to their reputation, and this in turn could affect the donations and support for the organisation. So by getting bad publicity, then maybe people will stop donating to the organisation. So there are a number of potentially damaging allegations being made, including those large payments and the purchase of the private jet, which looks like the money may not be being used appropriately. These allegations, however, could be rebutted if the organisation were to make the accounts public and explain the case for the purchase of the jet. For a charity receiving money from well-meaning individuals, the allegations have the potential to do lots of reputational damage. So they need to let people know what the business case is for the purchase of the jet. Perhaps it's completely legitimate that they need the jet in order for Mr. Hoy to go and get more money to publicise the organisation. The publication of the financial data is inadequate. It's not transparent enough and appears to be a poor attempt to give the appearance of providing information whilst really providing no useful detail at all. So this would not meet any stakeholder information needs, fails to address any of the concerns raised, and doesn't give any absolute financial figures in terms of income and costs and breaking those down into the detail. Transparency is about the detail. It's about really showing people and investors what you're doing with the money. So that's just a little bit about transparency and how we could relate it to a scenario. Now that we understand some of the key concepts when it comes to the governance of an organisation, let's think about who this is relevant to. Well, this is going to be relevant primarily to larger companies, so we're really thinking about listed companies here. Those companies that have shareholders. Because remember, we have that relationship between the shareholders and management, where the shareholders own the company and management run the company for those shareholders. And remember, the goals of management and the goals of the shareholders may be different. So we need these governance rules in order to make sure that management are acting in the interests of the shareholders. However, some aspects will be applicable to all companies, and it is good practice for all companies to try to bring in appropriate corporate governance rules. Also, we need to think about how relevant they are to not-for-profit organisations. There is a not-for-profit code that covers the governance of not-for-profit organisations. Remember, these will differ from profit-making organisations. We're thinking here about charities, government organisations, those organisations that aren't seeking to make a profit but have some sort of social requirement. They're there to provide a social benefit. So the not-for-profit code seeks to give some guidance as to the governance of these organisations. These organisations will differ in various ways. So the first bit of the Corporate Governance Code for not-for-profit organisations looks at board leadership. Remember, the board will be made up differently in a not-for-profit organisation. It will be made up of trustees. So that's a key difference to a profit-making organisation. Those trustees will want to implement the direction of that organisation. Now remember, in a profit-making organisation, that will be to make more profit, to increase wealth. Whereas in a not-for-profit organisation, we have a social reason for being, and we want to make sure that we are actually pursuing that reason. So the board needs to provide leadership to actually do that. The board should also be in control of the organisation, to control that strategic direction. Now that feeds into another key area of difference between not-for-profit organisations and profit-making organisations, in that the strategic direction will be different. The organisations that have profit in mind will be seeking to maximise the wealth of shareholders, whereas not-for-profit organisations need to provide value for money for stakeholders, those people who have contributed to the organisation. They need to make sure that the money is not wasted. So the board needs to be in control and provide control to ensure that that's the case. The board needs to be a high performance board, which means that they need to have people in place on the board that know what they're doing and are able to provide value to ensure that the people who have made donations are not wasting their money in doing so. And when it comes to the board review, that needs to be carried out on a regular basis. Also, we need to renew the trustees on the board. We don't want to stagnate when it comes to these not-for-profit organisations. We need the board to be renewed. We need to have new people in place so that they can provide new views and new expertise for that board. We also need to make sure that the board delegates appropriately. Remember, not-for-profit organisations may well be highly dependent on volunteers. So those volunteers need guidance, they need direction. So the board from the top needs to delegate down to those volunteers. It goes without saying that the board should have integrity. There shouldn't be any problem with the integrity of the trustees. The trustees need to perform in an ethical manner at all times with integrity and also with that social conscience that not-for-profit organisations often have. There also needs to be board openness so that there's transparency that we talked about earlier on in this lecture. So let's see how this relates to an illustration. So again, illustration 2, we're using the same information from illustration 1 so you know the scenario. Have a go at this illustration and then, as I say, work through the answer with me and learn from that answer. The requirement in illustration 2 is to discuss the ways in which charities differ from public listed companies and explain how these differences affect their respective governance structures. So this is related to the same scenario that we looked at in illustration 1, but it's more broadly just thinking about what the differences are as we discussed in the lecture. So the differences between our charities and our profit-making organisations. So firstly, the two types of organisations will be different in terms of regulation. Listed companies, remember, will be subject to all the provisions of company law plus any listing rules that apply if they're listed. Listing rules such as the need to adopt the combined code in the UK, which is the Corporate Governance Code we'll look at later on in this module, impose a number of obligations upon listed companies, such as non-executive directors, committee structures, range of reporting requirements, and lots of others. However, charities must receive recognition by a country's charity authority to operate, and then they receive concessions that charitable status confers. Now this may be a favourable tax treatment and different reporting requirements, but once they're a charity, they will be much different to the rules under ordinary companies' listing rules. So because charities are not public companies, they will not be subject to those listing rules, although depending on the country's rules, they may be subject to audit and have some reporting requirements. The second difference is in the strategic purpose of the organisation. So remember, listed companies will primarily exist to make a financial return for their investors, the shareholders. So that means they employ and incentivise people, including directors, to maximise long-term cash flows, to make profit. However, charities are different. The strategic purpose is to support the charitable cause for which the organisation was set up. So that's likely to be a social or benevolent cause, and the funds are donated specifically to support that cause. And this exception places a different emphasis on the purpose of governance. So the requirements of governance are different, as we saw in the lecture. Thirdly, the two are different in terms of stakeholders and social expectations. Society typically expects a business to be efficient in order to be profitable so that it can create jobs, wealth and value for shareholders. Also in a public company, the board consists of executive and non-executive directors, and it's accountable to the shareholders of the company. The principals are able to hold the board accountable through AGMs and EGMs. However, in a charity, the operating board is usually accountable to a board of trustees. So it's these trustees that act as the interpreters and guarantors of the fiduciary duty of care of the charity, because the beneficiaries of the charity may well be unable to speak for themselves, and indeed those who have donated to the charity want to get a good return for what they have donated. They want those beneficiaries to actually receive that money and for it not to be eaten up in admin costs, for example. So those are some of the differences that we see between a charity and a public company. We now understand the benefits of having governance within an organisation. We know some of the key concepts that we'll be looking at whenever we're thinking about corporate governance codes. We know that it's relevant to most businesses, especially large listed businesses, and it's also relevant to not-for-profit organisations. Let's just have a look at an introduction to stakeholders. Now, we'll be looking at stakeholders in much more detail later on, but we want to think about just who the stakeholders are in the company, because remember, our system of governance is there to ensure that we are acting in the interests of the stakeholders. So a good definition of stakeholders is anyone who has a legitimate interest in the business. So there are various internal stakeholders. First of all, the directors. The directors will be stakeholders within the organisation. Remember, the role of these directors will be, first of all, that corporate responsibility. So they will be the ones who take overall responsibility for the organisation. They set the strategy for the organisation. They determine what the strategic direction of the organisation is. Now, the interests of these directors will be pay and bonuses. So they want to be paid for the work that they do for the business. They also want to be paid bonuses, so they want to gain as much as they can out of it. They'll also be interested in garnering power in the organisation. They want to have the power to be able to carry out the strategic direction that they seek to implement. So when we're thinking about these stakeholders, we think about what their role is and what the interests are. That then enables us to think, how do we act in the interests of those stakeholders? Other internal stakeholders that we need to be aware of will be the company secretary. Company secretary will be in charge of compliance with the listing requirements, for example, and with company's house requirements. Also, the management. The management will be there to run the business. So that's the level of management just below board level. The board will determine the strategy, the management will implement that strategy and run the business. We also need to think about the employees in the organisation, and they will want their work to be provided for them. They'll want to ensure that they have a role in the organisation and that their job is secure. We may also consider the trade unions. Remember, they will be a stakeholder, and often they will be a powerful stakeholder. They will want to uphold the rights of the employees within the organisation, and we'll need to consider them if we're making big decisions that change the organisational direction. So those are some of the internal stakeholders we'll be looking at. External stakeholders, well, that will include the auditors. who report to the shareholders on the true and fairness of the financial statements. Again, we'll be looking at audit in detail in this module. The regulators. Remember, the regulators will make sure that we've implemented all of the regulations that we should do and that we're monitoring those regulations. When it comes to the government, they set the legislation that often governs the organisation. The stock exchange, if we're a listed company, will have rules and regulations that we must abide by and that we must make sure that we're sticking to. And remember, there are also the investors. Now, investors have limited power. They can always vote at the AGM and EGMs, but often that doesn't provide them with a lot of power. So they need to be considered whenever we're thinking about how to deal with them. And that's often what corporate governance codes are seeking to do, to make sure that the investors are looked after, to make sure that they're considered in the decisions that are made within the organisation. And we'll see that as we move through this module. So that was our introduction to governance. That will give you an idea of the sort of things that we're going to be looking at throughout the rest of this module and the areas that are of importance as we do so.